If you've ever paid a contractor abroad, bought something online, or, simply tapped your phone for coffee,
Mm,
you are relying on some of the most essential and, frankly, invisible infrastructure in the entire global economy.
it really is invisible.
Welcome to The Deep Dive, where today we are unpacking the hidden machinery that's powering digital finance. We're talking about the fundamental structures that move the world's money.
And it's so easy to just think of payments as, one single thing. But beneath all those slick fintech apps, you find these three completely different architectural foundations.
Right.
You've got high-value messaging, you've got instantaneous direct settlement systems, and then the really complex multi-party card networks.
And understanding the difference is key.
It is the absolute prerequisite for understanding modern finance.
So our mission today is to give you that necessary shortcut. We're going to contrast SWIFT's role as a secure messaging system against the direct fund movement of systems like FedNow and PIX.
And then we have to pull back the curtain on card payments.
Exactly, that whole multi-stage process and the economic friction that's embedded in every single card swipe. Let's dive into the rails.
Let's do it.
So let's begin with SWIFT. It's the dominant name when we talk about international bank transfers, but the most important conceptual hurdle, as you said, is that SWIFT doesn't move a single dollar.
That's the core distinction, and we have to make it really clear. SWIFT is a highly secure, standardized communications network. That's it.
So it lets two banks, maybe on different continents, talk to each other.
Perfectly put. It allows them to exchange payment instructions. It is the trusted messenger, which then enables their correspondent banks to initiate the actual debit and credit on their own ledgers.
But if SWIFT is just a messaging infrastructure, doesn't that dependency on separate settlement, which, that often relies on these really complicated correspondent banking relationships, doesn't that create a vulnerability, or at least unpredictable timing?
Well, yes, that's the historic challenge.
So why has it stayed so dominant for so long, if it doesn't even guarantee the movement of the funds?
It's really about two things: powerful network effects and trust. Every major financial institution is on it. But you've hit on the core tension, that lag between the message and the actual settlement.
Right. The where's my money problem.
Exactly. And that's precisely why initiatives like Swift GPI, the global payments innovation, are so crucial now. It doesn't change the underlying settlement, but it addresses the transparency issue.
So you can track it.
You can track it. It allows customers to track cross-border payments end to end, which massively mitigates that historic frustration of a payment just, vanishing into the system for days.
Okay, let's use that context of timing and trust to look at a system that does settle funds instantly, but on a domestic level. Let's talk about GPS in the UK. I think it gives us a really useful contrast.
It's a perfect contrast. GPS is fundamentally different because it settles in real time. It's what's known as a real-time gross settlement system.
And this is for the big stuff, right?
The really big stuff. High-value transactions, corporate deals, large property purchases, and critically, it settles in central bank money.
Can you just quickly clarify for us why settling in central bank money is so much better in this context?
Sure. It means there is zero settlement risk. The payment is final and completely irrevocable the moment it happens.
Why is that?
Because the liability is backed directly by the Bank of England. It is quite literally the gold standard for security and finality, especially when timing and a guaranteed payment are paramount. It just perfectly illustrates the difference between sending an instruction, which is SWIFT, and finalizing the transfer, which is GPS.
Now let's shift from those high-value wires to high-frequency retail. When we tap a card, we're engaging with a whole different architecture: Visa, MasterCard, and so on. The complexity hidden behind that simple tap is just immense.
Oh, this is where it gets really complicated because unlike a direct bank transfer, a card payment is inherently a four-party model.
Okay, let's break that down.
So you have you, the consumer, then you have the merchant, then you have the acquiring bank, which is the merchant's bank,
Right.
and then you have the issuing bank, the one that gave you your card. The card network, like Visa, acts as the critical router between all four of those parties.
And that volume of involvement is what drives the whole complicated process, isn't it? Can you walk us through the three stages that the network handles every time we pay?
Precisely. And it all happens in three distinct stages, usually within seconds. First up is authorization.
So checking if I have the money.
Exactly. The network checks with your issuing bank to verify that the funds are available or that your credit is approved. Second is clearing.
Okay.
That's where all the captured transaction data is verified and reconciled across all the parties. And then finally, you have settlement,
which is when the money actually moves.
Right, that's the actual movement of funds, and it typically occurs in batch processes later on. That's when money moves from the issuing bank to the acquiring bank and eventually to the merchant's account.
That complexity, requiring four separate parties, must introduce a necessary economic model. What's the key financial implication of this arrangement, especially for the merchant who has to accept the card?
What's most important for anyone running a business to know is that the compensation for the issuing bank, which is known as the interchange fee,
Ah, the famous interchange.
that's the one. It is the single greatest driver of merchant cost in the entire system.
And why does the issuing bank get that fee?
Well, they need to be compensated for taking on fraud risk, for covering customer service, and, for funding all those rewards programs and points that entice you to use their card.
And that cost just gets passed on to the merchant.
It gets passed on to the merchant via the acquiring bank. This whole economic structure is the inherent friction point that all these newer, lower-cost payment methods are trying to bypass.
Right.
But even with that cost structure, card networks maintain their essential role. And they're adapting very quickly through things like tokenization and digital wallets to secure their place in our mobile future.
Speaking of bypassing friction, let's talk about the real game changers in speed, the faster payment systems. Whether it's RTP or FedNow here in the US, or systems elsewhere like the UK's faster payments, what is the fundamental technological shift here? What sets them apart?
The core distinction is that these systems achieve instant, irrevocable, direct settlement between bank accounts.
So no batches.
No batches. They are designed to completely eliminate the reliance on multi-day batch processing, like the traditional ACH system used so heavily in the US, which might only process payments a few times a day.
Right, with all those delays.
Faster payment systems cut that lag down to seconds, 24/7, 365.
So if the funds are moving instantly, what does that actually unlock for FinTech and for the average consumer?
It creates a tremendous runway for innovation. I mean, instant settlement means instant wage access, which is huge for gig economy workers. It means instant insurance payouts, instant refunds.
It's everything.
Pretty much. Real-time cash management for businesses. It removes the latency that used to plague financial services. You can do real-time credit decisioning and complex automation that just wasn't possible when you couldn't trust the balance you were looking at until the next business day.
And the scale of this speed shift is maybe best demonstrated internationally. We have to look at India's UPI and Brazil's PIX.
These are just staggering success stories. India's Unified Payments Interface, UPI, is built on this direct real-time principle. It enables low-cost transfers between banks, wallets, merchants.
That's super.
It has actually surpassed the entire country's card transaction volume. It demonstrates speed and inclusion at a massive, massive scale.
And Brazil.
Very similar story. Brazil's PIX has seen astronomical adoption. It's rapidly becoming the standard payment rail for consumers, merchants, and even government payments. It's completely redefined how money moves in the country.
It's clear the trend is towards speed and directness, but the infrastructure doesn't look the same everywhere. Payment systems seem to evolve based on regional needs and, I guess, historical banking access.
Totally. If we shift our focus to Asia, for example, China offers a model that is heavily dominated by the digital wallet ecosystems of WeChat Pay and Alipay.
Right, it's all QR codes.
It is. Daily commerce is centered on QR code scanning. Now, the payments are still linked back to bank accounts, but they settle through domestic clearing systems like CNAPS. And this created a highly digital, mobile-first environment that often just sidesteps the international card schemes entirely.
And then you have regions where the payments ecosystem had to be built from scratch, really, because formal banking just wasn't accessible to most people.
That brings us to mobile money systems. The most famous is M-Pesa in Kenya and its imitators across Africa. These systems operate independently of traditional bank accounts.
So you just need a phone.
You just need a basic mobile phone and access to an agent network. They are essential infrastructure, offering financial services transfers, savings, merchant payments for huge populations that were historically underserved by formal banks.
And back in Europe, specifically the UK, we're seeing regulatory measures create yet another avenue for moving money, one that challenges those interchange fees we talked about.
That's open banking. It allows regulated third-party providers to initiate payments directly from a customer's bank account with the customer's explicit consent, of course.
And for merchants, This is a big deal.
A very big deal. It means transactions can be much cheaper than paying card interchange fees, establishing a genuine competitive alternative to that traditional four-party model.
Okay, so we have messaging, we have these complex multi-party flows, and we have instant direct settlement all operating in parallel. What are the global forces and standards that are starting to sort of unify these diverse infrastructures?
Well, the convergence drivers are speed, obviously, but also better data and greater interoperability. Many countries are now focusing on linking their domestic instant payment systems across borders.
Oh, that's interesting.
Yeah, Singapore, for instance, has already done this with several neighboring countries. It allows them to bypass that slow, costly correspondent banking chain for high-volume consumer transfers.
And the technical backbone that's facilitating this interoperability, there's a new global messaging standard we need to talk about.
Absolutely. That is the move towards ISO 2022. Think of it as upgrading the global language of finance from, say, a telegram to a rich, structured database entry.
So much more data can be carried with the payment.
Infinitely more. This technical shift is massive because it creates a consistent, data-rich global language for all payment types, whether it's a high-value CHAPS payment or a low-value instant transfer.
So this convergence towards speed and rich data is the essential foundation, the new runway, really, for every fintech company out there.
Exactly. Fintech companies aren't reinventing the physical movement of money. They're building sophisticated applications on top of these modern rails. They leverage that instant finality and the rich data from ISO 2022 to offer services like payment orchestration, embedded finance, and next-gen digital wallets.
This has been a really critical examination of the fundamental structures of finance. So whether you're dealing with the secure messaging of SWIFT, the necessary complexity of a four-party card transaction, or the rapid, direct settlement of a system like PIX, you now have the tools to understand that invisible infrastructure beneath every digital transaction.
And this rapid global development of instant payment systems, it raises a fascinating and, I think, a critical question for you to explore. Given that these new systems facilitate direct real-time settlement 24/7, effectively eliminating the risk and delay of old banking hours, how might this increasing prevalence of immediate fund finality fundamentally challenge or maybe even redefine the role of the global correspondent banking network itself?
So you're asking, is the future of cross-border finance direct, instant, and maybe entirely decentralized from those old messaging rails?
That's the question to ponder.